Hi everyone and welcome to this chapter. We are going to discuss about options and what are the Greeks associated with options and how to relate to those Greeks. So let's start. Now before we go through the presentation, I'll go to an Excel, explain you some Greeks like how do they work, and then I'll make you go through some examples to understand it a little bit better, and then we can come back to these slides and discuss the theory behind it. Okay, so let me open an Excel sheet. So this is chapter 17. So what are Greeks? Greeks are properties of option. Greeks are properties of option, right? The properties that option have, which in a way impact the price of an option. So all the Greeks that we are going to discuss, in a way they impact price of an option. Either they increase the price or they decrease the price. Okay. So we are going to discuss about 5 Greeks. So delta, gamma, vega, theta and rho. So let's start with delta. So what is delta? Delta is sensitivity to underlying price of an option. Delta is sensitivity to underlying price for an option. So for example, let's say an option has a delta of 0.6. What does that mean? It means, first of all, it is positive. So if price goes up, if underlying price goes up, options are going to go up. If underlying price goes down, options are going to go down. So first thing, it is positive. Second important thing that you have to focus on is it is 0.6. The number is 0.6. What does that mean? That means that for every $1 movement in option prices, for every $1 movement in option price, underlying price, so if underlying moves by $1, your call option or your option is going to move by 0.6 cents. Okay, so if your stock is moving by 10%, then your option is going to move by 6%. So 10% into 0.6, that is what we mean by delta. So when delta is positive, options are moving in the same direction, right? If price goes up, underlying price goes up, option price goes up. If underlying price goes down, option price goes down. So first thing, sign. Second thing, quantum. So if it is 0.6, it means for every 10% movement in underlying price, your option is going to move by 6%. Okay. Now delta remains true for small amount of movements. So you can very well predict the call option price movement when the movement in underlying price is small. So you have to remember that. Delta holds true for small movement. Delta does not hold true for long movements. Okay. So let's go ahead. Now for an call option, delta is positive. Means if underlying price is moving up, the call options generally move up. That is why delta is positive. So if you're a call option buyer, your delta is positive. So each time the underlying moves up, so let's take an example. So if you're doing options on Tesla, each time Tesla moves up, your call option is going to move up. If you're a buyer, if you're a call option seller, then delta is negative. It means each time the underlying Tesla moves up, you're going to lose money. So for a call option seller, delta is negative, right? So if price moves up, you lose money. If price moves down, you gain money. So call option sellers, delta is negative. For a put option buyer, the delta is negative. Means if Tesla moves up on a put option, you will lose money. If delta moves down on a put option, you will gain money. Okay, and same way put option seller, delta is positive. So price movements are related. If price goes up, put option seller benefits. If price moves down, put option seller loses money. So this you have to remember. What is delta? Delta is sensitivity of options to underlying price. So how does option price relates to underlying price? First is sign. If sign is positive, options and underlying move in the same direction. If sign is negative, they move in opposite direction. Okay. Then quantum. Quantum means If it is 0.5, it means for every $1 movement, there is 50 cents movement in the option price. Okay. And then call options have positive delta, put options have negative delta. So if you're buying a call option, you get positive delta. If you're selling a call option, you get negative delta. You get negative delta if you buy a put. If you sell a put, you get positive delta. Now, for between options, between call options and put options, delta approaches 1 as stock price increases. So delta goes up as the price goes up, right, for a call option. So if the exercise, if stock price starts going up and your options start getting into profits, so you're in the money, then delta starts approaching 1. Put price, if delta approaches -1 as the price increases. So delta goes up as the price goes up, right? But in the negative direction. Then delta decreases for out of the money option and it increases for in the money and at the money option. So the graph is as the options start getting out of money. So if it is a call option, if the price starts falling and your option starts getting out of money, then delta goes down, right? It increases for in the money and at the money option. So we are going to discuss this again when we cover slides. Okay. So that was delta. Then what is gamma? Gamma is rate of change of delta. How fast does the delta change? Okay. It is rate of change of delta. Now, whenever you have large movement in stocks, then your movement in options, when you have large movement in stocks, the movement in options that you get is combination of delta and gamma. So you have to factor gamma in when the movements are large. Okay, gamma is highest for at the money option. It is low for in the money and out of the money option. So when we go to the slides, we are going to discuss that. Gamma decreases with time. So longer term options have lower gamma, right? Their delta is less sensitive to change, right? While shorter term options have high gamma. Okay. Now, most portfolio managers do not adjust for gamma. They do focus on delta because delta is important. So you're an option trader, you should focus on delta. But not many people adjust for gamma because it becomes very difficult to do that. Next is Vega. Vega is sensitivity to volatility. Now all options, call and put, have positive sensitivity to volatility. That is, Vega is positive. It means that if you're an option buyer and if volatility goes up, then volatility in the market goes up, then both option prices, call or put, goes up. With everything else remaining same, if volatility goes up, prices of option go up. Okay. So if you're a call buyer or put buyer, it is positive. If you're a call seller or put seller, it is negative. So when you buy options, you want volatility to go up. If you sell options, you want volatility to go down. Vega is highest for in the money options and it tapers right out of the money and at the money. So it is highest for, actually it is at the money options. It is highest for at the money options. So when we discuss slides, we are going to discuss it again. So then is theta. Theta is sensitivity to time. Thing that you have to remember is options lose value as time progresses. So each time a day passes, options will keep on losing some value. Okay. So that is sensitivity to time. It is negative for option buyers and it is positive for option sellers. So if you are an option buyer, if you're not trading, if you're not executing your options, each day progresses, then options keep on losing value. For everything else remaining same. So if price doesn't move, if volatility doesn't move, but as the time will progress, an option buyer will keep on losing money. Okay. For an option seller, it is opposite of that. Each time day progresses, you keep on making money. Okay. Now rho is sensitivity to options, sensitivity to interest rates. It is positive for both call and put. So if interest rate go up, call and put prices go up. If interest rate goes down, call and put prices go down. So based on this, just to recap, delta is sensitivity to underlying price. Underlying price moves, option price moves. Gamma is sensitivity to rate of change of delta. So it means if price movements are large, then delta will change and you have to factor that in. Vega is change to volatility. Theta is time, right? How much value will they lose each day? And rho is sensitivity to interest rates. So let's look at few options. Okay. So the first option that we are going to discuss, I'll just zoom out a bit so that it is clear. So we are looking at Apple, right? These are screenshots from Bloomberg. Okay. So we are looking at call options. So just to understand, right? So Apple, the current price is 123. The exercise price that we are looking at, okay, so underlying price is 123. It's an Apple stock. The price of call option is 8.53 right now, right? And these are the things that we need to focus on. These are options, option Greeks. So what is the Vega of this call option? So Vega of this call option is 0.24. What does that mean? That each time volatility goes up by 1%, this option is going to move by 0.24%. So Vega is sensitivity to volatility. If market becomes more volatile, these options are going to go up, but how much they will go up? By 0.24 times. Okay. Then delta in percentage is 51%. So each time there is 1% move, right, this option will move by 0.51. So each time there is $1 move, right, there will be a 0.51 cents move in this option. Now delta is generally true for small movements, but you have to adjust it by gamma if you have to factor in large movements. Okay. Then theta is 0.05. So each day this option will lose $0.05. Okay. Time value is given and all those things are given. So let's look at one more. We are looking at Google now. So Google, the underlying price is 1830. Okay. So price of option is given. We have to focus on option Greeks. So option Greeks, for this delta is 50%. So every $1 move creates 0.50 cents move in this option. Gamma is 2.66. So you have to adjust big moves by this gamma. We are going to see how to do that in the PowerPoint. Vega is 3.58 now. For every 1% move in volatility, this option moves by 3.5%. So it is much more sensitive to volatility than the Apple one. Okay, theta is 60 cents almost. So each day you lose out 60 cents if you're a buyer. Each day you make 60 cents if you're a seller. Rho is 0.2. So every time interest rates moves, so this will move by 0.02 times that interest rate move. Okay. Then let's look at TSX 60, right? Call option again. So TSX 60 delta is 47%. So each time there is $1 move in TSX, this option is going to move by 47. The current price is 419. The level of index is 17 grand. Okay. Vega is 34. So each time volatility moves up or down by 1%, this option is going to move by 34%. So it is much more sensitive to Vega. Theta is $2.60. So each day from this 419 as an option buyer, you are going to lose $2. If you are an option seller, you are going to make $2. Rho is 0.19. So every 1% move in interest rates, this will move by 0.19 times 1%. Okay, so this is how you relate option Greeks to option prices. So let's do one more, right? One more example where we discuss put options. Okay, so this is Bloomberg terminal. I am directly showing it from you. We're looking at TSX 60, but we are looking at a put option now, right? So delta for it is negative. So please note why it is negative, because if price moves up, you will lose value. If price moves down, you will gain value. So it is 50%. Means every $1 movement up, you will lose 50 cents. Every $1 movement down, you will make 50 cents. Okay, Vega is 34 again. So every 1% move in volatility, this option will move by 34%. Theta is $2.60 negative, please note. So as an option buyer, you always lose money if you stay in the option, and as an option seller you make money. How much money do you lose if you're a buyer? $2.60 each day. Price is 509, so each day you will lose $2.60. Okay, Rho is 0.23. So we can look at some other stock too. Let's look at Tesla. Let's look at call first. So we're looking at call. So delta is 57. So every $1 move, 57 cents move in this Tesla option. The price is $88 right now. So every time Tesla moves up by $1, this will move by 57 cents. It goes down, it will move down by 57 cents. Then Gamma, you have to adjust by Gamma for large moves. Vega is 1.10. So every time volatility moves, this option will move by 1.1 times that volatility change. Theta is 49 cents. So each day it is negative. So each day you're going to lose money. How much you're going to lose? 49 cents. Okay, Rho is 0.01. Rho generally doesn't matter, like option traders. As an option trader, we don't focus much on Rho. Now let's look at a put option. So put option, please note delta is negative now. So each time Tesla moves up, you lose 42 cents. Each time Tesla moves down, you make 42 cents. Okay, then Gamma is given, so you have to adjust large moves by Gamma. Vega is 1.10. So each time volatility moves, this option moves 1.1 times Vega, right? And what is volatility? We generally presume that volatility is the VIX index. Okay, so Chicago board gives out a VIX index. So each time volatility moves, okay, each time this volatility will move, options will move. And how much they will move, this is a proxy. This is not exactly, because you need to look at implied volatility, but this is like a proxy for that. So each time volatility will move, if it goes up, right, options will gain value, they will become expensive. If it moves down, options will lose value. So as a buyer, it benefits if you get in at lower volatility and price goes up. As a seller, it benefits if you can get in at higher volatility and VIX goes down. Okay. So best place to buy option was in the month of Feb when volatility was low. Then it skyrocketed. So along with the price move, you also got the VIX move. So you would have made a lot of money. Best time to sell option was here when VIX was very high. Okay. So with this background, let's cover PowerPoints. So let's see. Now they are going to first discuss about hedging, right? How can you hedge your positions, right? You can use it if you have an option position, mostly you're selling options, how you can hedge it and what are the problems with that, and then they will come to Greeks. So what is happening? A bank has sold 300,000 European call options on 100,000 shares of a non-dividend paying stock. So you have all these details. You can compute the value of value per option, and then you can compute the total value. So it is 240,000, right? So you have sold option. So sold a call. So each time index moves up, you lose value. Each time this stock moves up, you lose value. Each time it moves down, you gain value. So you do not want the stock to move up. Okay. How does the bank hedge its risk to lock $60,000 of profit? How can you hedge your risk? So answer for that, you can take no action. So each time it will move down, you will make money. Each time it will move up, you will lose money. You can do a covered call. So if it starts moving up, you can buy shares. Okay. So you can cover your call positions, right, with portfolio by buying the actual shares. So what will happen? Each time the stock moves up in the market, your portfolio will gain money, but your option position will lose money. So net you're zero. But other way around too. Each time the stock moves down, you will lose money on your portfolio and you will gain some money on your call position. So it's not a good strategy to do a covered call because net you're zero, right? So if you do a covered call, you lose out on the upside, right? So one way to do it is do covered calls, buy stocks only when the underlying stock in the market starts going up. Do not do a blanket covered call. So instead of doing a blanket covered call, only buy stocks when it starts going up so that you can hedge your risk. So buying $100,000 of shares as soon as the price reaches 50 and sell $100,000 if the price goes below. So each time, this is K is the level at which you buy. Each time stock goes up, right? Each time the underlying stock goes above K, that is $50, then you buy. Each time it goes below, you sell. Okay. But then this strategy has a lot of trading cost. So better strategy than that is to understand Greeks and then hedge your portfolio. So Greeks are partial derivatives with respect to model parameters that are liable to change. So that means each Greek represents one variable that changes option price. Usually traders use Black-Scholes-Merton model when calculating Greeks. So that is what we saw on Bloomberg. It was using Black-Scholes-Merton model to calculate prices of Greek. The volatility parameter in BSM is set equal to implied volatility when Greeks are calculated. This is referred to as practitioner's Black-Scholes model. So first is delta. Delta is the rate of change of option price with respect to underlying. The rate of change of option price with respect to underlying. So for an call option, each time the stock goes up, right, the option price goes up. So this is the graph that shows if stock is going up, the option price is going up. So delta is positive for a call option. Now please note, delta is, you can predict the option prices with delta if moves are small. So if move is only between A to A dash, that is here, you can predict it. It will be from B to B dash. Okay. But if move is large, it goes A to, let's say, A double dash, that is here, you cannot predict it with delta because delta is this line, but the actual movement is this. So this adjustment that you have to do is the gamma adjustment. So delta predicts option prices for small moves. Delta does not predict option prices for large moves. Okay. A trader would be hedged with a position, right? How to hedge it? Go $100,000 short on call options and buy 600 shares if delta is 0.6. So delta gives you a hedge for small movement, but delta is not a good predictor for large movement. Gains or loss on option position is offset by loss or gains on stock position. Delta changes as the stock price changes and time passes. Hedge position must be rebalanced. So delta keeps on changing. Now delta hedging, this involves maintaining a delta neutral portfolio, that is perfect hedge. Even if stock moves up or down, you do not lose money. The delta of European calls on non-dividend paying stock is given by ND1. So delta is calculated as delta of calls is ND1 and delta of puts is ND1 minus 1. So this is how delta looks like for calls and for puts. So delta keeps on going up as the stock price keeps on going up. So as you start getting into profits, as you turn your options into in the money options, delta will keep on going up. Okay, as the stock price keeps on going up. Now delta for puts keeps on going down as the price goes down, and it is really -1 when it approaches 0. Okay, now how does delta react to time? Now delta for in the money call option, so if you buy some call option when it was in the money, it will keep on rising as the time progresses. For out of the money options, delta will keep on falling as time progresses, and for at the money options it is relatively stable. So this is movement of delta over time. Now cost in delta hedging. Delta hedging is a return option, involves buy high sell low trading rule. So what do we do in delta hedging? We try to remove delta from a portfolio. Okay, so let's see how to do it. So if stock price is 49, delta is 0.42, you purchase 0.42 into 100,000, that is 52,000. But if stock starts falling, you do not purchase, you sell. So what are you doing? Right, this is little bit complex the way they have described it. So you're selling some options and you want to hedge. So when you sell options, the way to hedge it is do a covered call. What is a covered call? You're selling options, so you will buy stocks, but you will only buy stocks if stock prices are above a certain parameter. So if price goes up, then you will buy stock. If price goes down, you will sell those stocks. Okay, that's how they do delta hedging. So that is what they have discussed. Next is theta. Theta is a partial derivative. It's a parameter that describes the rate of change of value of the option with respect to passage of time. The theta for call and put is usually negative. What does that mean? As a buyer of call and put, each time a day passes, you're going to lose some value from your derivative, from your option position. This means if time passes with the price of underlying asset and the volatility remains same, the value of long call or long put declines. So this is how this is theta for a different option. So theta is generally very high for options that are at the money. So $50 is at the money option. So it is high, theta is high for options that are at the money. It is generally low for in the money options or out of the money options. Okay. Now, how does it progress with maturity? So if you have longer maturity options, theta is low. If you have shorter maturity options, theta is high. So if you're buying an option that expires only in 1 month, the rate of decline in your option position will be higher. If you're buying an option that has expiry after 2 years, the rate of decline each day will be lower. Okay. And for at the money options, the theta decline is the highest, followed by out of the money and then in the money. Next is gamma. Gamma is rate of change of delta with respect to price of underlying asset. Gamma is greatest for options that are at the money. So what is gamma? Gamma is adjustments that you have to make to find out the actual change in option price for a given change in underlying. Because we have seen the graph, right? So this straight line represents delta. This curve actually represents the actual price movement. So actual price movement is relatively constant for small movement. So if stock is moving from A little bit here or little bit there, the option price can be predicted because it is on the straight line. But for large movements, you cannot predict it using a straight line. So you have to make those adjustments, right? So you have to add gamma, right, when price goes up, and you have to subtract gamma if price goes down. right? So that's the adjustment that you have to make, that is given by gamma. Okay, gamma is greatest for options that are close to the money. So at the money, gamma options are highest, right? They decline as the price moves away. Okay, next is maturity. So gamma for options that are going to expire, it means relatively near, is high. Gamma for options that are long term is generally low. So gamma addresses delta hedging errors that are caused by curvature. So price movements that you cannot predict using delta can be predicted by combining gamma with it. Okay, so what is the formula for that? So movement in options is equal to theta into movement in time plus 1/2 into, right, gamma and movement in stocks squared. So you don't have to worry about it. You just need to know that you have to make adjustments whenever the movement is large. So the total movement of derivative is theta plus rho, right, r s0 times delta. So I'll tell you, this is the time element. How much value, if you're a buyer, you will lose value. So theta would be negative. So how much value you're going to lose each day. Then this is the delta movement. Delta movement means if stock is moving in upward direction, as a call option you will make money. If it is a put option, you will lose money. So how much money you will make or lose given by delta. And this is the gamma adjustment. So 1/2 sigma square s0 square and into gamma. This gives you the daily movement of option. So daily movement of option is how much time has passed, how much stock has moved, and what is the delta adjustment. So what is the gamma adjustment? So once again, how much time has passed, theta, how much stock has moved, delta, and how much gamma you need to adjust if the movement is large. Next important variable is Vega. Vega is rate of change of value of derivative with respect to implied volatility. Now Vega is positive for calls as well as put. So each time volatility goes up, premiums go up, right? Each time volatility goes down, premiums go down. Now Vega for calls and put, it's nearly highest at the money option. So 50 is for this discussion at the money. So Vega is generally high for at the money options. It is low for out of the money options. Okay. Now managing delta, gamma and Vega. Delta can be changed by taking a position in underlying assets. To adjust gamma and Vega, it is necessary to take position in option or other derivative. So if you want to hedge against delta, if you want to hedge against movement in stock, if you're a call option seller, you will buy stock. If you're a put option seller, you will short stock, go short on stocks. But this cannot be done if you want to hedge gamma or Vega. So if you want to hedge gamma or Vega, you have to deal with options. So they have given an example. So portfolio has delta of 0. So it is delta adjusted, right? It has gamma of 5,000 and Vega of 8,000. So what position in option 1 and underlying asset will make portfolio delta and gamma neutral? So you have to take option 1 has 0.5 gamma and option 2 has 2 Vega. So you have to hedge 50,000 gamma. So how to calculate it? It is 50,000 divided by 0.5 and 8,000 divided by 2. Okay. So answer will be 10,000 long options and 10,000 short options. So what is the position in option 1? Will make answer long will be 8. Yeah, so they have jumbled up the numbers, but it is generally divided. Okay. So one way to do it is put it in an equation. 5,000 plus 0.5 weight of option A plus 0.8 weight of option B, and you want to make gamma 0. And next is, okay, this is the right way to do it. How to do it? You want the portfolio gamma to be 0. So 5000 gamma is already existing, and you're taking positions in option 1 and option 2. And gamma for option 1 is 0.5. So 0.5 into W1 plus 0.8 into W2 equals to 0. And second, you have to make Vega also 0. So 8000 plus 2 into weight of option 1 plus 1.2 into weight of option 2 equals to 0. Solve this equation. You should get weight of 1 is 400 and weight of 2 is 6000. So you have to buy 400 options and option 1 and 6000 option 2. Okay. Next is rho. Rho is rate of change of value of a derivative with respect to interest rates. So how the option prices react to interest rates. So hedging in practice